And good morning, everyone. We're past Nicholas and it's Wednesday morning. My name is Randy Price. We are the Price Group. And for the next 45 minutes, our sole task in life will be to make sure you are a better educated consumer. We're going to be talking in our list of different webinars, creating income for retirement. Income is necessary, putting food on the table, putting gas in the tank, going on vacation, and we're going to talk about some different ways to create income, as well as some of the pitfalls associated with where we are in the market cycle. So along with Matt Price, welcome. Who are we? We're a family-owned and operated team that specializes in retirement planning. 40 plus years of experience. We do follow a fiduciary standard, and retirement is where we have a majority of our business. Fully 90% of our clients are retired or nearly retired. So we do feel like we know something, and hopefully we can give you some information that will be helpful in the next 40 minutes or so. We are a registered investor. Go ahead, Matt.
A little bit about our firm. Steward Partners comes from the biblical definition of stewardship. Like Randy said, operate as a fiduciary. Our firm has over $25 billion of assets. I think it's really important to note we're not owned by a bank or a brokerage firm. And so that's a key delineation for anyone that is shopping for a financial advisor of, can you serve as a fiduciary? Our back office, our custodian, Raymond James, happy to report they took no TARP bailout money in 2008. We think that's a true litmus test for the financial security and solvency of each of these firms. There's a number of big firms that most everyone on the call would recognize that without some government intervention back then, would probably have gone out of business. And I'll brag a little bit on Randy because he's humble. He's been awarded by Barron's, Forbes, Financial Times over the years for our team, a top wealth management team in Texas, been recognized on CNBC. Maybe if you're on our email, seen our Wealth Coach podcast, which we put out on a regular and recurring basis. And we think education is really important. We're both certified financial planners. We both went to the Wharton School of Business to obtain our CIMA, Certified Investment Management Analyst designation, and continue with all that upkeep on an annual basis. So Randy's going to warm our brains up here just to kind of get us loose and ready to go. We'll look at kind of where we think the markets are. We'll talk about the top 5 risks of retirement, and then we'll talk about how producing income in retirement can help mitigate some of these risks and what it looks like to create what we call our Live Well plan for a future or maybe current retirement. But why did you attend this webinar? And there's probably dozens and dozens of ways to answer this question. But the bottom line is this: everyone is looking for the 3 C's: comfort, confidence, and clarity as it pertains to their retirement. And so our goal and what we want to do to help clients is provide comfort, confidence, and clarity for where they are, and most importantly, where they're going.
Okay, a little bit of a brain teaser here to make sure you're awake after a good night's sleep. What was the annualized total return of the S&P 500 index, the 500 largest stocks, in the decade of the 1930s? Remember what happened? The decade started out with the country in the Great Depression, and it ended with us trending toward the Second World War. Was it A, 0, B, minus 3.4, minus 7.1, or D, 2.3? And the answer is A, 0%. So anyway, there are periods of time where the market does not make a whole lot of money. In fact, a lot went on during that time. You could argue a lot going on at this time also.
So let's take a quick look at where we are in the markets. This is a really busy chart moving from left to right. This is 1900 through June 30th of this year. Green is good, red is bad. Not saying anything you probably don't already know. But what we want to draw your attention to here is how long these bull markets are historically. And here, 24 years, here, 17 years, it's our thought, and a lot of people we follow, bull markets tend to last anywhere from 15 to 20 years. We think that the bull market we're currently in started spring of 2009. With that being said, we think we have a number of years left with this bull market. Now, that does not preclude us from normal pullbacks. Normal pullbacks, typically, if you look back at history, we get a 10% pullback once a year. We get a 20% pullback once every 2 to 3 years. So very normal, and even a bull market to get those type of pullbacks. But like we said, we think the bull market does continue for a number of more years.
So bond prices are at all-time highs. U.S. Treasury yields are hovering at historic lows. A lot of people will focus on the 10-year Treasury bond. It's the rate by which most of the mortgages are set. The long-term fixed mortgages currently this morning trading right at 1.3%. You've got negative real yields after inflation for 5-year Treasuries and negative yields for some bonds across the globe. So what's happened is even with low interest rates, because of a fear of the stock market, because of a number of issues, there's been a lot of money across our country as well as other countries flow into bond and bond funds over the past few years. And that's very interesting as we take a look at that. Next slide, please. And we will take a look at, are bonds really safe? Well, let's go back and look at 3 periods of time. 1920 to 1940, you retired and you said, I'm going to play it safe. I'm going to put my money all in government bonds, government bills, notes, etc. And on a real rate of return after inflation, you did very well. You made over 6%, and you were very happy. You lived. Your money was guaranteed by Uncle Sam, and you felt like it'd been a good investment. Take that forward to the middle area, the period that started in 1941. Obviously, what happened in 1941, we were in the midst of the Second World War. And what you found in that period, long period, you saw your portfolio, if it was invested for 40 years, you had almost a negative 2% a year real return. Remember, we're talking about interest rates less inflation, which will get you to what we call a real rate of return on your money. So after inflation, you actually lost money for 40 years. And then the third period that we'll look at, 1982 to 2009, sort of like the first period, 1920 to 1940, we saw that Treasury notes, Treasury bills had a positive real rate of return. And again, the person that played it really safe had a good experience from investing in bonds. Now, if you're looking at investing, if you're looking at retirement specifically, and you're saying, I'm going to call it safe, I'm going to put all my money in fixed income or a lot of my money in fixed income. The bottom line of this slide is there's been times where bonds have done really well. There have been times, a long period of time there in the middle, 1941 to 1981, where bonds did very poorly. And obviously, we can tell with great accuracy what these 3 periods of time have done. But what you're most interested in is going forward, 2021 forward, 2022 forward, on what interest rates and what bond prices may do. Remember, we have an inverse relationship. As interest rates go up, bond prices come down. So if you think interest rates are going to go up because of inflation, the government printing money, instability in economies, etc., a number of reasons there, there's not a lot of upside in bonds as interest rates go down, but there would be a lot of downside in bonds as interest rates could go higher. Just as a little bit of history, again, we said the 10-year U.S. government bond was about 1.3 now. The high on that 10-year U.S. government bond, over 15% back in the early 80s. So anyway, what does history tell us? It's a little bit murky. Stay tuned. So high debt levels, we talked about the government printing a lot of money, running big deficits. The high debt levels historically can slow economic growth. And there's many people that look at the economy and say that because of this, that interest rates are going to be stuck low for a longer period of time. The U.S. recessions there are the shaded portions. The most recent data there is 2020. This information comes from the Federal Reserve, but again, the federal debt and the total debt as a percentage of the gross domestic product, whenever it gets over 100%, typically it's not been good news in the long term. So something we'll have to face as we go forward politically as well as financially. So what are the top 5 risks of retirement? We're going to run through here, and you should be well aware of these. Retirement risk number 1 is longevity, living too long. If you're a 65-year-old in good health, you've got a 33% chance to live to 90. You're a male, 44% chance of a female, and a couple 63%. So the probability is high for you needing your money to last a long time. Many of our clients today have been retired for longer than they were working. Mix in inflation, which we're going to talk about, and it gets really to be an issue. But retirement risk number 1 is longevity. The average 65-year-old will live to be 85. 1 in 20 baby boomers will reach age 100. That's a startling statistic.
The second risk of retirement that we always take into account is inflation. The rule of 72 is something we'll talk about a lot. How long does it take your cost of living to double? Take the number 72 divided by your rate of inflation, and that will give you how long it takes the cost of living to double. So 3% inflation, your cost of living is doubling every 24 years. What if inflation clicks up to 6? Well, your cost of living could double every 12 years. So inflation in retirement really is a hidden tax, and it's something that is paramount that we include in your planning, your retirement plan, what we call our Live Well plan, to make sure your expenses are moving higher on a regular and consistent basis.
Retirement risk number 3 would be market performance. If you are working and putting money in your 401k, your performance with no withdrawals really does not depend on what we call the sequence of returns. There on the left, you see on the green, 29% rate of return, followed by 7% rate of return, and then a negative 15% return. And you end up in the same place as if you had totally reversed in the bottom in red what rates of return you had been getting. So from a standpoint of that, sequence of returns has no influence, no real interest for anyone while they're in the accumulation phase. Now, turn it around, and if you have performance which starts with a negative rate during year 1, the sequence of returns has a dramatic influence on that, and you'll actually end up, in our example here, $100,000 starting asset, getting an average return of 7% with inflation, you would run out of money. So bottom line, sequence of returns has a dramatic effect on cumulative returns in the distribution phase, and that's why, as we'll talk, we use retirement modeling through Monte Carlo simulation to retire you 1,000 times to give you a confidence level that this won't be an issue, this won't be a problem with you spending money during retirement.
A continuation on the third risk of retirement, market performance. Look here. The big thing we're always talking about with clients is how do we not stub our toe with the investment program. And so our goal is never to keep up with some arbitrary index, but our goal is to protect capital in a falling market. And this chart is a good illustration of why that is our thesis for retired clients. If your portfolio is down 20% and you're taking out 4% a year, and this also includes inflation, intuition might say, hey, well, you need 20% to get back to, quote, break even. But you don't need 20% to get back to break even. In this case, you need 36%. Or what if the market's down 30% or your portfolio is down 30% and you take out 5%? You need almost 60% just to get back to where you were prior to the downturn. So we think it's really, really important to protect capital. Our goal with our entire process is let's take the least amount of risk possible for you to be, quote, successful based on your goals, objectives, dreams, desires, using conservative assumptions down the road.
Retirement risk number 4, investing without a process. What does that mean? Let's look at a little bit of a history. This is a great chart, a little bit busy, but follow along with me. The dark line there, the dark green line, is the performance of the S&P 500, 500 largest stocks. And then the lime green, the lighter green, shows when people were putting money into stocks, if you will, mutual funds with what we call equity fund flows. So you can aggregate across the country when people are buying stock funds and when people are selling stock funds. And look at our line there. When the market was going up, people were putting money into the market hand over fist. In fact, the circle there, buying high, showed that the most money went into equity mutual funds at the time when the stock market was at one of its high points. You follow that along and you go to 2008, which is the next circle over, and the stock market went down, had a big pullback. And what happened? People sold equity mutual funds like crazy. And what did they do? They put money into bond funds because of fear, because of being worried at an all-time high. The big mountain there of gray is the amount of money that was flowing into bond mutual funds. So the flow is wrong. The old adage, buy low, sell high. When you put money in when things are looking rosy, when you put money in when everyone else is putting money in and you feel like you've just got to own some stocks, typically that's not the right time. The old adage of you want to buy when there's blood in the streets, one of the famous investors from history has told us. But again, a lot of people have bought bond funds and they basically bought high and sold low, which is opposite of what we like our clients to do. Along this same thought process, the 20-year annualized returns there of the average investor you see are 2.9%, barely above inflation, below what you would have made from your average house or from bonds or the stock market, S&P 500, high yield bonds, or real estate investment trust. How can that be? Well, there was a book out written by a gentleman who ran a mutual fund for one of the large mutual fund companies. And he was asked a question one time. They asked a question, they said, Mr. Lynch, what is the biggest regret you have from your time as a successful portfolio manager? They thought this was a really keen question because he would say something like, well, I didn't invest in a stock when it was first coming out, or I missed investing in the oil stocks when they did really well, or technology stocks, et cetera. And he said, oh, that's a really easy question. He said, the average investor in my fund came nowhere close to the average return of my fund. And he looked puzzled, the investment writer. And so he said, let me explain that. He said, we can, through our fund company, we can see when people put money in and when people take money out, and then we can average the results. And he said the average investor didn't do nearly as well as the fund did. If the investor had bought low and sold high, or put money in on a regular basis, or kept money in and not gotten scared and taken money out at the wrong time, they would have done much better. And this study here for the average investor over a long year, a 20-year time period, shows that emotions do get in the way. And therefore, our tenet number 4 here is you do need an investment process to be a successful investor, especially during retirement. Risk number 5, healthcare. 46% of people say they will need less than $100,000 for healthcare costs in retirement. And 33% say they don't have any idea what retirement costs are going to be. And so according to a 2018 Fidelity Healthcare study, the average couple will spend over $280,000. And of course, that is a little bit dated. So given inflation, et cetera, that would cost more. Unexpected costs from illness, energy, or simply growing older can really impact your spending projections during retirement. Again, we want to take this into account and then model what happens if one part of your retirement budget gets out of line, or you have to spend more than you expect. So again, retirement risk number 5, healthcare. Let's take that into consideration.
So a lot of uncertainties out there as we move forward. How do we face these uncertainties? Let's look at what we think a few are the key considerations to answer that question. Step 1, creating a retirement roadmap. Said earlier, we call our retirement roadmap our Live Well plan. We call it that because Randy and I are a little bit cheesy, but also because we really want clients to live well in retirement. And a lot of people will think of retirement as just an event. I'm going to retire on the 1st of October, and that is that, and then retirement is off and running. Well, retirement planning from an investment and financial perspective, it's an ongoing process. We also believe that if you don't have a plan that's written down, it's really not a plan. And a retirement roadmap should help you answer the following questions. How much can you spend? How long will your money last? What rate of return do you need? And we think arguably the most important, how much income do you need to produce with an investment portfolio? That's a big key consideration. We'll talk about that a little bit more in a minute. But like we said, our Live Well plan, because everyone in retirement does want to live well. We think step number 2, stress testing your portfolio. What does the risk budget look like in retirement? And so we'll look back at a 2020 type scenario. In 2020, last spring, market from peak to trough was down round numbers about 30%. Look back at 2008. 2008, the stock market was down a little over 50% from peak to trough. And how did your portfolio hold up during these time periods? We think that is important on a kind of a few different levels, but one of them is, like we discussed earlier, what rate of return do you need to get back to break even? That's kind of the numbers we can quantify. But the first question here, number 1, how are you going to emotionally handle that? When you're working, you see that your portfolio is down, and you say, well, I'm not retired. I'm putting money in. Maybe the company's giving you a match into the 401k, and you just look at it and you get back to work. But in retirement, you have no more money that's being added on a regular and recurring basis. And so what we see a lot, our clients can become a little more emotional when compared to when they were working. So love the quote by Benjamin Graham: the essence of investment management is the management of risk, not the management of returns. Third step, maximize Social Security benefits. We just have dozens and dozens of stories on, oh my goodness, I didn't know that my spouse was entitled to this benefit. I didn't know we could start it here. Married couple actually has over 80 ways to file for Social Security benefits. And so we're kind of like the general practitioner when it comes to Social Security. We can answer a lot of the plain vanilla questions. We have a team behind us that really specializes in this area, and we'll refer it out if and when that does become complicated. So with that being said, big thing to consider, and something we obviously will include in a Live Well plan for clients.
So how do you become more efficient with regard to the payment of your income taxes? Well, a couple ideas. If you're over 70 and you're giving to a charity defined as a 501c3 organization, you can actually reduce part of the amount of money that you're required to take out and give that to the charity, and therefore save some income taxes. It's harder and harder for the average retired couple with the limitation on real estate taxes, et cetera, especially if there's no mortgage, to come up with enough deductions to itemize each year. So we call that qualified charitable distribution, QCD, and that can work really well to get to reduce your income taxes. If you don't have an IRA, but you have some appreciated stock, we have a lot of clients give away stock on a regular basis. Take the most highly appreciated stock. If you still want to own it, then use the cash that you would have taken to give to the charity and buy the stock back. Otherwise, it's a way, if you've got too much of that, perhaps the company stock, to use gifting of appreciated shares as a way to diversify and cutting that concentration. And if you are right on the cusp of being able to itemize your CPA, you can work with your CPA to itemize every other year what we call bunching your deductions. For example, where you're paying your property taxes for 2021, perhaps in 2022, and then paying them early at the end of 2022, so you get two in 1 year. So again, check with your CPA, TurboTax, whatever you do, but there are some ways to become more tax efficient. Cash flow planning, wow, this is the biggie. For a 65-year-old, there's a 94% chance at least one spouse will need income at age 80. The rule of thumb, if you're already retired, you probably know this, 70-80% of salary prior to retirement. One client summed it up. He said, when I was working, I only spent money on Saturdays. He said, now every day is a Saturday. And so anyway, planning for events, what happens if you spend more? We've heard so many people say, well, I'm taking out 4% and everything's fine. I just want to take out another percent. It's only 1%. Well, the statistical difference between 4 and 5 is huge. And you can see there in our chart that as you do stress the portfolio more by taking more out, you do have a higher probability of running out of money based on our hypothetical couple who are age 65 and invested money there at 4, 5, 6, 7, et cetera %. So some would argue, based on the low fixed income, the low rates on fixed income, CDs, money market, tax-free bonds, et cetera, that the age-old rule, if you will, where you could take 4% out of your portfolio, stand the ups and downs of the portfolio. In fact, there have been a lot of papers, articles, lectures on this, the 4% rules, it's affectionately called. Someone wrote an article that we thought had a catchy title, and that is 3% the new 4%? Again, if you take into account that the stock market has done above average, and it may revert to its mean rates, as well as the interest rates on fixed income, which would be typically a big piece of your portfolio as well. It may, and if you're retiring early, it may be necessary to use 3% as the new 4% as far as that. Again, having a plan, having our Live Well plan, we'll look at all of these and come back to you and say, based on the risk that you're willing to take, here is your sustainable withdrawal rate based on history, law of large numbers, et cetera. So we do think that planning during retirement is so very important.
The next step, we think, to really overcome the uncertainties we discussed earlier, produce income in retirement. And so here's a look back for I guess it's 80-ish years, and what percentage of the total return of the stock market, total return meaning growth plus dividends, what percentage came only from dividends? And you can see here about 41%, which is a real startling figure. Almost half of the total return of the stock market has come from dividends. And we're big believers in companies that not only pay dividends, but have historically increased those dividends year over year. And the reason we think that is if we can get clients to a place where they're not spending the principal and they're only spending the income, it takes a whole lot of risk out of the retirement equation. And then on top of that, if we can isolate these companies that have a propensity to increase their dividends year over year, That's how we're combating inflation, giving you a raise on a regular and reoccurring basis. So, like we said, big believers of dividend-paying stocks. And here you can see the point of this slide would be companies who cut dividends historically underperform for the next 10 years. So dividend growers have outperformed the dividend payers, which have outperformed the stock market. But when you see companies cut dividend, that's typically a bad sign. So what we're doing with our investment strategy as it pertains to dividend-paying stocks is if we ever get a whiff of the board of directors, executive management, that they're going to cut a dividend, we're trying to exit the stock as soon as possible. Just because you can see here, after that happens, returns are pretty anemic moving forward for those companies.
Step number 7, plan for long-term care. People are living longer. Average woman will need about 3.7 years of some sort of home health care, long-term care. Average man will need 2.2. The national median cost for a nursing home private room in 2020, almost $106,000 per year. And assisted living facility costs since 2004. That's about 17 years, or up 79+%. So a big potential place where people run into issues, not planning for long-term care. And again, this needs to be addressed as part of your retirement income, either self-insure or lay that risk off to an insurance company. Step number 8, consider hiring an advisor. Emotions are really big, as we've showed when investing. Mistakes are certainly more costly as you approach and enter retirement. Reduction of stress, advanced investment options, strategies for additional income, and the average investor have underperformed are all sort of reasons for doing that. Again, we sit down with folks all the time. It's not a good fit 100%, but I tell people that we'll both know whether there's common ground. If there is common ground, we talk about moving forward. If there's not, then we shake hands, certainly part as friends, and we can be a resource later on if something changes in one's situation. Okay, let's talk about our investment process. We hear people talk about many times, well, who's your investment guide? Investments are a very important part of retirement planning. Again, a Benjamin Graham quote here. Benjamin Graham was Warren Buffett's mentor. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that's likely to get you to where you want to go. We talk about holistic financial planning. If you're not doing that, we think you're missing out. This would be taking into account, yes, investments, but look at everything that goes with it. Insurances, the medical, whether it be homeowners insurance, whether it be flood insurance, et cetera, cash flow, estate planning, obviously income tax planning, retirement, and goals and objectives. What are you going to leave to your children? You're going to leave all your money to your children. You're going to leave some of it to charity. What is your legacy? Is your legacy just a financial legacy, or is there something more important for your family to be remembered for? So all that goes into what we call holistic financial planning, holistic wealth planning. We are truly convinced you need much more than just an investment guide.
So part of this planning, when we're putting together the Live Well plan, we're creating what we call our family index number. What rate of return do you need to get from here to there? And this number is not a cookie cutter number. It's personalized based on you, your family, your specific goals, dreams, desired. And this is how we track the progress of your Live Well plan. Are we ahead of track? Are we behind track? Are we right on track? And so in addition to monthly statements, clients receive a quarterly performance update. And this performance update is tracking the growth or the decline in your portfolio against this family index number. And so it's a really easy way to keep track on, hey, this is what we set up to do. Are we beating those goals? Are we behind? Or are we right on track? And we've had a handful of clients tell us it's really helped them give them more clarity as it pertains to where they're headed. And, like we've talked about earlier, we're trying to meet the needs of the clients, reduce the stress, and we're rarely, usually never, trying to outperform some volatile market. So I think we've probably covered it already, but we are firmly convinced you need an investment process. This will discuss how much you can spend in retirement, how do you invest your retirement portfolio. Discipline and income generation are at the core of what we're doing. We have over 15 different investment strategies. We briefly mentioned our dividend-paying stock strategies as one of them, but what we like to do is commingle a number of these strategies together because it gives us a higher probability of success of being, quote, successful over a long period of time. So multiple strategies, all geared toward retirees to produce income on a regular and reoccurring basis.
So what's our goal when we sit down with folks that are close to retirement? It's very clear we're wanting clarity, comfort, and confidence with regards to their financial situation. The best way to do this is through our holistic wealth planning, what we call our Live Well plan. If it's not written down, it's not a plan. And again, looking at your resources, looking at what you're going to spend during retirement, and then playing the what if game. What if my expenses are up, or what if I live longer, or what if the rate of return is less? Again, providing clarity. Many people tell us for the first time they have clarity about their financial future. This clarity leads to confidence. The confidence will lead to comfort. That's what everybody is about. And so we do invite you to take us up on that. Not a cost or an obligation. Again, as we sit down, we both will know if there's common ground, and we think it's a great educational event to find out where you are, but more importantly, where you are going. As you sit down and interview an advisor, several things to be aware of, several questions to ask. Does the advisor hold themselves out to be a fiduciary? If you're not working for an independent firm, almost impossible to do so. Does the advisor represent you or represent the company they work for? Do they have a transparent cost structure? We think experience is a huge, huge thing to be aware of. Have they done postgraduate education to be an expert? We talk about when we ask clients to find an attorney to update some of their estate plans. You don't want an attorney that does with a doctor analogy, you don't want a doctor that does big toes on Monday, gallbladders on Tuesday, and maybe hearts on Wednesday. If you have a heart issue, you want to see a doctor that does hearts Monday, Tuesday, Wednesday, Thursday, and Friday. And again, you want experience. You want someone that's certified and works in retirement. So our niche, 90% of our clients are retired or close to retirement. You want a personalized plan, not just some cookie cutter investment strategy approach that you call an 800 number, and you and 5,000 other people that are same age are doing. You want a firm that has a low client to advisor. Service is really important, and based on the way we've staffed the Price Group, that is really important to us. You want a group that communicates well, speaks in a manner you can understand. We've talked about the written holistic plan, our Live Well plan, anticipates your needs, and you hear from them on a regular, consistent basis. So feel free to email us to request the Price Group's complimentary guide, 10 questions you should ask your financial advisor. We'd be happy to send that to you. So we want to thank you for your time. Please feel to reach out with any questions or comments. That's the Price Group there, Maddie Kearns, Tiffany, myself, Matt, and Melissa. Our email addresses, phone numbers there. Again, we think that the important thing is for you to be proactive and reach out, make sure you understand where you are, invest your time before you do invest your money. So on behalf of Matt Price, I'm Randy Price. We're the Price Group. Hope to hear from you Have a great day. Thank you so very much for joining us. Hope to talk later. Bye-bye.